All right, let's jump right in. Today we're breaking down a really fascinating financial report. What it does is slice the market right down the middle, separating the real winners from the stocks that are just pretending.
I mean, this is the million-dollar question for any of us who invest, right? You're looking at two companies, they seem almost identical on paper, but one is about to take off like a rocket, and the other, well, it's just a rock, and it's going to sink. So how do you tell them apart before it's too late? This analysis gives us a kind of X-ray vision to do just that.
So how does it do it? Well, it's not magic. The report lays out a super clear map, a set of really strict rules that helps cut through all the noise and focus on what actually matters.
Okay, so what are these rules of the game? There are 5 of them, and they're all about common sense, really. First up, low debt. Simple, right? A company that isn't drowning in debt is just safer. Second, high efficiency. The report uses a metric called ROCE, which sounds complicated, but it just asks, is this company a money-making machine? Is it getting a great return on every single dollar it puts to work? Third, a fair price. You could find the best company in the world, but if you pay too much for it, you're still going to lose money. So, no overpaying. Fourth, it has to be a decent size. We're not looking for tiny garage-based startups here. And finally, number 5, it has to be one of the top dogs in its own industry. Only the companies that ticked all 5 of these boxes even got a look in.
And you know what happened after they ran everything through that filter? The report came back with this really powerful finding. It said the market is basically split in two. It's bifurcated. There are 2 paths you can go down. One path leads to genuine quality and value. The other one? Well, that path is littered with traps. They look good, they seem cheap, but they're built on quicksand. So let's start by walking down the good path, shall we?
All right, this is the fun part, the path to real value. We're talking about the winners, the companies that have both amazing quality and a great price tag. Let's meet them.
So who's at the top of the list? Rank number 1 is National Aluminum Company, or NALCO. This is a total giant in the aluminum world. And the report basically screams that it's a deep, deep discount right now.
Okay, let's get into the numbers because this is where it gets really interesting. Look at that PE ratio, 8.15. That is just exceptionally cheap. A single-digit PE is rare for a quality company. And debt, it's basically 0. We're talking about a fortress balance sheet here. On top of that, it's got that high efficiency we were looking for, a 22% ROCE, and to cap it all off, profits are growing by almost 37% year over year. I mean, cheap, safe, efficient, and growing, that's the whole package.
And this quote just nails it, doesn't it? Near zero debt, single-digit PE. It's a textbook deep value play, especially in a market where commodities are doing well. You really can't argue with that.
Moving on to number 2 on the buy list, NMDC Limited. This is India's top dog when it comes to iron ore. So it's a similar story to NALCO, a commodity powerhouse, but it has an extra little kicker. It's a great stock for anyone looking for income thanks to its juicy dividends.
And the list of high-quality buys doesn't stop there. We've also got Natco Pharma. Check out those insane profit margins, almost 37% at a PE of just 10. Then there's Mahanagar Gas, or MGL, which is a utility powerhouse with a near monopoly and an incredible 37% ROCE. And finally, a name you'll definitely know, Infosys, one of the best IT companies out there, offering that top-tier quality, but at a price that's actually reasonable right now.
Okay, so we've seen the good path. Now we have to talk about the other one, the path to the hidden traps. This is where things get tricky. We're going to look at companies that look good, maybe even great on the surface, but they are absolutely not what they seem.
So what exactly is a value trap? It's a stock that looks cheap. It has a low PE ratio, it draws you in, makes you think you found a bargain, but lurking underneath, there's a huge problem, a fatal flaw that's going to cause the stock to go nowhere, or even worse, fall off a cliff. It's a trap, plain and simple.
And the poster child for a value trap, according to this report, it's Kestrel India. Seriously, if you just glanced at its stats, you'd think it was a dream investment. Let's pull back the curtain and see why it's not.
Just look at these numbers. A 55% ROCE? That's incredible. Practically no debt. A PE that seems perfectly reasonable. So you have to ask, what's the catch? Well, the catch is everything that isn't in those numbers. Their sales have been totally stagnant for years. But the real killer? The world is moving to electric vehicles. And what businesses can stroll in? Engine oil. That's a massive existential threat to their entire business model. Suddenly, that beautiful picture doesn't look so hot, does it?
Now this is the perfect way to see the two paths side by side. We've got two utility companies, MGL and IGL. They're in the same business, but MGL is a buy. Why? It has a near monopoly in its market, a powerful protective moat. Now look at IGL, a sell. Its biggest customer, the entire Delhi bus system, is going electric. That's not a risk, that's an existential threat. And sure, the stock is a bit cheaper than MGL, but the report says that discount is nowhere near big enough to make up for that ticking time bomb under its business. It's the difference between a fortress and a house of cards.
The avoid list keeps going. We've got Wipro. It's a big name in IT, but it's just not keeping up with rivals like Infosys. It's the laggard of the group, but you're not getting a discount for buying the weaker player. Then there's Petronet LNG, a company whose business model has a built-in ceiling on its profits because of regulations. And finally, Chambal Fertilizers, a classic cyclical trap that's getting hit by falling demand and is totally dependent on government subsidies. Not a great place to be.
So we've laid it all out. The good, the bad, and the ugly. But the big question is, what do you do with this information? How can you actually use this in your own portfolio? Well, the report gives us a playbook for that.
And here it is. It doesn't matter if you're an aggressive investor hunting for big growth, or if you're more balanced, or even if you're a conservative investor just looking for steady income. This breaks down how you could combine these top buy ideas into a portfolio that actually fits your style. This makes the whole analysis super actionable.
Okay, but before we get too excited, we have to talk about the risks. A good analysis isn't all sunshine and rainbows. You always have to ask, what could go wrong here?
And the report is pretty clear on the main headwinds. For stocks like NALCO and NMDC, it's simple. They live and die by global commodity prices. If prices fall, so do their stocks. For Castrol and IGL, that whole EV transition thing isn't some far-off problem. It's happening right now. And for IT companies like Infosys, the pressure is on margins because of rising salaries. You've got to keep these things on your radar.
And this last chart just wraps it all up perfectly. It's a simple value score that combines efficiency with price. And look at this. NALCO and NMDC are way up there with excellent scores. They are the real deal. But then look at Castrol. It scores moderate. And that's the whole point of a value trap, isn't it? It's not terrible, it's just moderate. It looks good enough to fool you, but it's just not in the same league as the genuine opportunities.
So there you have it, a map to a market that is split into two very different roads. One leads towards quality, value, and potential rewards. The other is full of those deceptive traps we've been talking about. Now that you've seen the map, the real question is, which path are you going to take?